Hi, I'm Hubert Centers. Welcome to Absolute Wealth's weekly edition of Centers Strategies. Let's take a look at this week's strategy.
Okay, in this week's strategy, we're going to talk about how to draw a line in the sand. In other words, we're going to learn how to protect ourselves. Like, you can kind of get seduced by a company or the fundamentals and stuff like that. And I'm going to caution you really to not get attached to any equity, stocks, options, or future. Remember, we're trading or investing. We're not getting married to these things, right? So you want to be committed to your position, but you only want to be committed to your position as long as it's working in your favor. So the tactic that we're going to use for this, the strategy, is we're just going to use Fibonacci retracements. And I've got mine formatted so that it only shows me the most important two. And for me, in my opinion, that would be the 50%, okay, the 50% retracement and the 61.8% retracement. So within the confines of a normal market move, so let's pretend that we're going in an up move direction. It is very normal for that market to pull back a 50% move from point 1 to point 2 and spend a little time here before it returns in the up direction. It works the exact same way in the down direction. So if you have a market that's going down, it's very normal for it to retrace 50% of that move and then roll back over and continue its trend to the downside. Right? So what we're going to do is we're going to use the Fibonacci, the 50% retracement, and we're going to use the 61.8% retracement, and we're going to take a look at an up move and a down move. So the first thing you have to figure out is, number one, where are you in this thing at? So we're going to pretend that you're in Netflix. How long is your trade or your investment? How long are you in this thing? Are you in it for multiple days, multiple weeks, multiple months, or multiple years? So your time horizon is going to be important. So I'm going to say in this one, we have been in it since the beginning of the year. All right, so we're going to say 2011. All right. So what we're going to do is we're going to draw from 2011 right here at the low, and then what we're going to do is we're going to draw from the most recent high. At any point when it comes back here, after we go from this low point to that high point, then what our job is to do is to buy those pullbacks if we're investing or buying pullbacks. All right. So what we would do is we would from point 1 to point 2 is we would buy this. That's normal, right? Because we want to buy that. And then after it breaks down below the red line, so the yellow line is the 50%, the red line is the 61.8% retracement. Once it goes below that, this now acts as resistance, okay? That's resistance, and it used to be support, all right? It was support, and now it's resistance. It breaks down below it, and then it obviously goes lower. So the line in the sand, based upon your time horizon, is if this thing retraces below the 61.8% retracement and closes below, then what I recommend is you get out, or at least bump up your stop or trail your stop much more aggressive. So now that equity was Netflix, so now let's take a look at something a little bit different. So now we have on the screen, we have Apple, which is near and dear to a lot of people's hearts. Obviously, they make some good equipment. All right, so what we're going to take a look at is we're going to say, all right, we've been in it since the middle part of June, okay? Middle part of June is our time horizon, and we're going from the low of this point to the high of that point. So in this situation, we buy the pullback, boom, it pops up. Buy the pullback, boom. Now, we've got a new high in place, so now what we have to do is we move the Fibonacci from this point to that point. And now if Apple comes back down to 366, we're a buyer. If it closes below 358, as you can see, 353. So as long as it goes to 366, we're a buyer all the way down to 353. If it closes below 353, we're gone. Okay, it just means that it's gotten too weak and it has a higher chance of coming back down here to $311. So remember, the next time you're either buying something long or you're shorting a retracement, the 50% zone is pretty normal, but if it closes below its 61.8% retracement, the thing is changing its direction and you need to reassess your position. Good luck, hope it helps, and I'll see you next week.